1 in 5 retailers in Singapore is looking at short-term leases of less than a year in flexible store formats. That's according to the Singapore Retailers Association, which notes this figure is about 10% more than last year. Landlords are also increasingly open to such flexible structures, with some even reserving units to host pop-ups year-round. Nasyrah Rohim with more.
Swap, sell and buy second-hand styles. That's the business model of sustainable fashion firm Swapaholic. Once an entirely online business, it took up a 9-month lease in the heart of Singapore's nightlife district.
The short-term lease allows us to experiment. It allows us to see how a concept like ours fits in with this mainstream retail environment, measure impact, gather insights, and then commit to the long term.
It's something that the Singapore Retailers Association is also seeing. Instead of the typical 3 to 5 year contracts, more retailers are opting for lease terms that could be as short as a month to stay flexible and manage costs.
There are actually obligations that retailers have to be mindful about. So if the retailer is actually, stuck in a fixed-term lease and they are unable to actually get out when there is a need to get out, then they would actually come into an issue of maybe a cash flow issue or the issue of having not enough manpower to manage stores.
One analyst tells me that these shorter leases come at a price, generally 5% more expensive than traditional long-term agreements.
For shorter leases, they tend to command higher rents on a per square foot basis compared to a standard 3 or 5 year lease term. And the reason for this is quite simple. Shorter tenures carry a higher vacancy and turnover risks for the landlords, so that flexibility is actually priced into the rent.
Even then, more landlords are embracing the idea. Take, for instance, this unit at Clarke Quay, which has been designated to host pop-ups. It's alongside novel concepts like this dog grooming and swimming gym.
The successful ones we intend to retain and to continue growing them. It's also feasible for us to set aside that 1 or 2 units that can have certain constant pop-ups that will always be new and exciting to our shoppers. These are ways we can look at how we're attracting the day crowd as well, and it becomes a day to night and an all-day kind of environment that is suitable for everyone.
Malls like the one we're in are owned by Real Estate Investment Trust. That's a group of investors who have pulled together funds to own and run properties. Their goal to ensure stable income and long-term growth. So far in 2025, major REITs have posted positive rental reversions. What this means is the new lease is signed at a higher rate than the old one. An analyst says that when it comes to having more pop-ups, REITs may not have the risk appetite.
For the REITs, because they do have certain internal benchmarks that they have set, they like stability. So majority of their leases will still be based on a permanent lease structure, but they will also be able to weigh what percentage of their leases can operate on a more flexible structure, so that they can also use that to rejuvenate the kind of tenant mix that they want to have within the mall.
For Landlease, striking this balance is a constant conversation between landlords and tenants.
If we have certain plans to enhance the more offerings, we may approach the tenants to say that, hey, would you be, considering to scale up, scale down, or taking additional or bring in even additional offerings from international or even homegrown brands.
She adds that this includes looking at whether brands suit the profile of shoppers in the mall to create not just a place to buy things, but a space to connect and build community.